Good morning, good afternoon, and good evening, everybody. Welcome to this episode of the Note Closers. As always, Scott Carson, excited to be up here with you today. Today's episode, we're going to dive into all the different types of self-directed IRA accounts. You'd be surprised how hard it is to get a self-directed IRA custodian to come on and talk about the different types of accounts. We've had different folks on before. Obviously, Quest IRA, we've had on before, NewView, Advana, we've had American IRA, Commonwealth American IRA, and trying to get them just to come on and share the basics of what's going on with self-directed IRA accounts and the amounts that you can contribute to, all the different ones. They just don't seem to get it. So I took it upon myself today to go through all the different types of self-directed IRA accounts, the amounts that you can put away to these, how these work, and then also going through how you can find the complete list of these things. So this episode, first of all, is dedicated to Nisha, one of our WC clients who's looking for a new self-directed IRA we refer her out to. This is also dedicated to Mark Rupert out of Sarasota, Florida, who was messing around with my AI clone on how to pull self-directed IRA investors off the counties. We spent some time with him. And definitely to Mr. Nick Hill 9100 off of our YouTube channel, who said, thanks for sharing. Nick, we appreciate the comments. Yes, we do comment on those. We keep track of everything. So thank you guys for listening, watching, asking questions, and being involved full tilt. So let's dive into the content today. Now, there's a variety of different self-directed IRA custodians. There's an older list out there that's a little outdated. If you just go Google ultimate list of self-directed IRA custodians, it'll give you that list. This is one thing that we've used in our workshop, stuff like that. You can also go to the IRS and search for there. That's going to be a little bit of a different thing. Don't look for trust, but look for self-directed IRA custodians. There's a bunch out there, 40 to 50 of them, okay? And we'll have a new company on, probably going to be sponsoring the podcast here relatively soon. I had a good conversation with them this morning. They called me. I didn't call them. But let's dive into going through all the different things you can do with your self-directed IRAs. And first, let's dive into what the amounts are, what you cannot do with them, and all that good stuff. All right. So let's give you a breakdown of self-directed IRAs and other investment account options, including the contribution limits of this year. And that will change. Now, with it being August, it's like, oh, the year's over halfway over. Technically, the amounts don't change until April 15th of 2026. So technically, guess what? You have about 8 months left to contribute towards 2025's contribution limits and then also to 2026. So you still got a bit of time to cap these out. All right. First of all, what is a self-directed IRA? A SDIRA, as it's commonly referred to, is a type of individual retirement account that allows you to invest in a wider range of assets than a traditional IRA, okay? This can include real estate, precious metals, private equity, and more, all right? And there's a note to this, too. The IRS still prohibits certain investments like life insurance contracts and collectibles, but there is a bit of a clause to that we'll cover in a minute here as we get to the end where I share some different things, okay? Now, let's go through some of the different contribution limits. That's the first thing. General limit is $7,000. And that's the same thing basically as 2024 on a self-directed IRA. Catch-up contribution, if you're over 50, you can contribute another $1,000 to your amount. So technically, you can put away up to $8,000 in a self-directed IRA if you're 50 plus, okay? Technically, in a calendar year, you could do actually more than that because you could contribute $7,000 now and then $7,000 on January 1st towards 2026 limits, okay? Now, types of IRAs. There's a traditional IRA. This is where it's funded with tax deductible. So it's basically post-tax dollars, okay? And earnings grow tax deferred until retirement, okay? Distributions in retirement are taxed as ordinary income based on your tax bracket when you use it. Now, this is funded, all right, with pre-tax dollars. So like it's a tax deferred account. So it's like a 401k kind of that way, all right? A Roth self-directed IRA is funded with post-tax dollars, okay? After tax dollars. So it's basically left over your paycheck. You go contribute $7,000 to a Roth IRA. And then any type that you spend or pull money out there, the distributions are tax-free. So it can grow. Anything you invest with a Roth IRA grows tax-free, whereas a traditional grows tax-deferred, okay? And yes, you can put away as little as like $200 and buy a note or something like that, or a wholesale option fee. Definitely great stuff. Okay. let's dive into 401k, self-employed, or solo 401k. So what it is, a retirement savings plan for self-employed individuals. This is a solo 401k, or small business owners. It allows both employee and employer contributions. All right, now here's the employee contributions. All right, is basically $23,500. Okay. Once again, you have a catch-up contribution if you're over 50 plus, so you can contribute additional $7,500. All right, so that means you could put away up to $31,000 if you add the math right. Okay. Now the total contribution, employee plus employer, is around $69,000. This includes both your contributions as the employee and any contributions you make as the employer. That's pretty good. All right. Solo 401ks that's a lot chunk of change. Now a SEP IRA. This is a SEP IRA is different from a solo 401k. A simplified employee pension is what SEP stands for. So SEP IRA means employee pension plan. It's a retirement plan for self-employed individuals and small business owners. It allows you to contribute a percentage of your self-employment income. Okay. Now, the nice thing about this is you can contribute up to 25% of your net self-employment income, but no more than $69,000, because that's the limit for a 401k. So if you figure $69,000 times 4, that's $276,000. If you make that, you could contribute up to 25% of that into a SEP IRA. Pretty good. You just got to put it away. All right. Then you have a simple IRA, which is a savings incentive match plan for employees. Simple versus SEP. It's a retirement plan for small businesses. So an employee contribution can put up to $16,000 into a simple IRA. The catch-up contribution, again, allows you, if you're over 50, to put away $3,500. And then the employer contribution, typically the employer matches employee contributions up to 3% of their compensation, or makes a 2% non-elective contribution. Okay, so basically up to 3%. And you see that happen in a lot of 401ks, where a company say, hey, well, we'll match dollar for dollar up to 3% or something like that. Okay, it's the same thing. If you have employees and you want to put together, this would be the easiest thing versus going through a whole 401k administrator and stuff like that. Just do a simple IRA if you're going to match them up to 3%. And of course, they can put more into it. And yes, you can do simple IRAs that are like the traditional, where it's tax deferred, or you could also do part of the Roth IRA aspect of it, where it's tax free. Something to think about. Now, another self-directed account that doesn't get a lot of, I don't think get as much bang for the buck as an advertisement as it should, is the HSA, or health savings account. Now, there are some clauses with an HSA. Okay. First of all, an HSA is a tax advantage savings account that can be used primarily to pay for qualified medical expenses. You must have a high deductible health plan to contribute. So you've got to have high deductible health plan outside of this. You can't just have this by itself. You've got to actually be paying into a deductible insurance plan. Okay, health plan. Okay. Now the contribution limits for an individual is $4,300. A family, it's $8,600. Once again, there's an additional $1,000 catch-up provision if you're 50 plus. Now, the great thing about an HSA is you can use it for eyeglasses. You can use it for all sorts of medical devices and then get reimbursed out of it. Nathan Long from Quest IRA used to talk about all the time how he would self-direct his HSA. He would use the money in his HSA to invest. He would actually buy something with his HSA funds that was allowed to, and then invest in that, and then basically pay his HSA back the profit margin of it. So it worked out pretty good. He actually bought like a plane engine, or somebody I know bought a plane engine with their HSA because they bought it and flipped it and then made the money back into it. So it's another investment type of account, but it has to be used towards your medical expenses. Okay. Now, some important considerations. As always, I'm not here to give you legal advice or financial advice. It's essential you consult with a financial advisor or tax professional to determine the best type of account for your individual circumstances. There's also some income limits too. Like Roth IRAs have income limitations that may prevent you from contributing. I think if you make more than 125 grand a year as an individual, or just under 200,000 as a married couple, you can't have a Roth IRA. You can still have one if you had before that, but you just can't contribute to a Roth IRA anymore if you hit that. Okay. Investment risk. Self-directed IRAs can involve greater risk due to the wider range of investment options. So make sure that whatever you're buying and you understand, thorough due diligence is critical. So you get educated whether you're investing in apartments or notes or fix and flips. There's some things that you can do and can't do. We'll get to that in a second, okay? Most of the time, you're also, as far as fees, the custodial fees, SDIRAs often have higher fees than traditional IRAs due to the specialized administration required. And I've seen this all across the board. I've seen anywhere from like a flat $200 a year fee to 1% of the total investment amount or the balance amount. So keep that in mind and make sure you talk with your administrator too. Some are better than others. Some give you much better, higher quality customer service, and others are hard to get, okay? Tax implications, understand the tax implications of contributions and distributions for each type of account. There are tax penalties if you invest in a Roth IRA and you pull out early before you hit 55. You're going to end up paying a tax on that money, usually about 10 to 20%. So keep that in mind. And there's quite a few prohibited transactions that you don't want to mess around. And let's go in here. Okay. Let's go through the breakdown of these prohibited transactions. And these rules are designed to prevent you from using your IRA for personal benefit. That's the big thing. Or engaging in self-dealing, where you're doing the deals yourself, okay? Violating these rules can lead to serious consequences, including the loss of the IRA's tax-deferred status and potential penalties. I've seen people do stupid stuff, self-deal, and lose the whole balance of the IRA as a tax-deferred status. They get taxed on the whole thing. So don't do something stupid. Don't try to get around the loops. It's not a good thing to do. All right. So transactions with disqualified persons. I always kind of call it the vertical show, the Macarena, okay? This is the broadest category. You, the IRA owner, cannot engage in transactions with disqualified persons. Now, disqualified persons include you, your spouse, your ancestors, parents, grandparents, and your lineal descendants, grandchildren or children. So basically going up and down the family tree, you can't do it, okay? Any entity, your corporation, partnership, trust, etc., in which you or any of the individuals listed above own 50% or more of that interest. So any companies or entities the family tree owns, okay? Fiduciaries of your IRA, the custodian or any advisor who exercises control over the IRA. So that's something you can't be doing a deal with a bank or a lender or something like that who controls your IRA, okay? So let me give you some examples. So like you can't selling some examples of transactions that'll violate this is selling property you personally own to your self-directed IRA. Can't do that. If you're going to buy a property using your IRA, it's got to go in your IRA's name. Okay. Buying property from your child's company with your self-directed IRA. Can't do that. Buying a rental property in your IRA and then allowing your child to live in it. We've seen somebody do that stupidly at Texas A&M before for the kids. Okay. Paying yourself or a disqualified person for services rendered to the SDIRA. Like you couldn't go pay yourself to mow your lawn at your property because that would be self-dealing, okay? Direct or indirect benefits, something you or any disqualified person cannot receive any direct or indirect benefit from the self-directed IRA's assets, okay? So like if you buy an investment home, you can't go rent it. You can't go live in it, all right? Using a property owned by your SDIRA or as a vacation home is completely faux pas, okay? Can't borrow money from your self-directed IRA. Now, you could borrow money from somebody else's self-directed IRA that's not in your family tree, along with them borrowing money from you. We've seen that done before, okay? Allowing a disqualified person to live rent-free in a property owned by the SDIRA. That's like I talked about with the rental property or the family buying a house for their kid going to A&M. Using assets owned by the IRA as collateral for a personal loan. You can't do that. Now, there are lenders out there that will give a loan on a property with an SDIRA where you're not personally accountable for it, where it's just a property. So there are some lenders out there that understand that will do that. You cannot be personally accountable for your IRA. Now, what you can do, you can't borrow money from the IRA from your kids or your family tree, but your IRAs can partner together to buy an asset. So let me give you an example. So like if you've got 50 grand in an IRA and your dad's got 50 grand in an IRA, you two could partner up to buy a property together for 100 grand, okay? It's just that the profits are going to have to go back into the IRAs equally, all right? You're not borrowing money, can't borrow money, but you guys can partner together to buy a property together. And we've seen people, I don't want to say pool money, but like 4 people, their kids' self-directed educational savings accounts. And ESAs, you can contribute up to $2,000 a year towards your kids' education and make it self-directed. Okay, I forgot to talk about that. But you could partner with the buy one note. It's just going to be the profits would come back in the direct relationship and proportion of the amount invested. All right. If you are a fiduciary of your own IRA, which is often the case with a self-directed IRA where you direct the investment, you cannot use your position to benefit yourself. You can't get paid commissions on that. You can't get a cut of the profits at all. So, like, you cannot be paying yourself excessive fees for managing the self-directed IRA's investments. Using the self-directed IRA's assets to invest in a company you own where the SDIRA receives preferential treatment. That's all no. The IRS prohibits SDIRAs from investing in certain types of assets, even if the transaction is not with a disqualified person. You cannot purchase life insurance contracts. That's the big thing. Your SDIRA cannot purchase life insurance. And collectibles. This includes art, antiques, gems, stamps, coins, alcoholic beverages, and other similar items. There's an exception. Certain gold, silver, and platinum coins, meaning specific IRS requirements, are permitted. So you've probably seen a gold IRA, a precious metal IRA. There's examples to that you can do. That's kind of the clause. But like I said, other collectibles, art, things like that, wine list, you can't do it. Now, one of the weirdest exceptions I see is that somebody's IRA did buy horse sperm. Yes, they bought horse sperm as an investment, and they got a cut of the ponies, basically, when the ponies were born out of it. It's the weirdest thing, but yes, you could do that, all right? Let's go get some more details here. Personal use of your IRA-owned property, we talked about that. Using the IRA-owned rental property for your own vacation, even for a short period, is a prohibited transaction. You can't go work on the property. You can't go mow the lawn. You can't do it. You have to have a third-party person to go do that for you. And those expenses, that's a big thing too. Those expenses for that property have to be paid out of the IRA. If you pay an expense out of your own personal pocket, that's a big faux pas. So that's one thing you got to keep in mind. If you're buying a property with your IRA, keep extra in there to pay those expenses. You cannot personally provide services to maintain or improve the property owned by the IRA. I guess I got ahead of myself there. Unless you are doing it so as a bona fide independent contractor and receiving a reasonable compensation that is paid directly to the business and not to you personally. Okay. This is a complex area, requires careful documentation. Wouldn't even mess around with it. Okay. You don't want to commingle funds. Combining your personal funds with your IRA funds in any investment is prohibited. Okay. Now, yes, that's commingling. You could use part of your IRA to buy a property and go from there and use somebody else's funds. Like loans, you cannot loan money from your IRA to yourself or any other disqualified person. That's the family tree. Purchasing property for personal use and then transferring it to your IRA, you cannot do that. You cannot buy a property in which personal funds with the intention of immediately transferring it to your IRA. The IRS will view this as an attempt to circumvent the prohibited transaction rules, and you'll lose the tax benefit of the whole account. Indirect benefit. This is a kind of a broad concept they talk about. Even if a transaction doesn't directly benefit you, if it provides an indirect benefit, it can be prohibited. For example, using your IRA to invest in a business owned by a close family member, if that investment disappropriately benefits them. Let's talk about this. The consequences of prohibited transactions. This is the scary stuff out here. The loss of your IRA status. The entire IRA can lose its tax-deferred status as of the first day of the year in which the prohibited transaction occurred. This means all the assets of the IRA become taxable as ordinary income. Okay? Don't FO. All right? Don't F around and find out. Okay? Penalties, you may be subject to penalties for violating the prohibited transaction rules. Key takeaways, as always, this is why you use the self-directed IRA custodian. The rules surrounding SDIRAs and prohibited transactions are complex. Always consult with a qualified tax advisor, attorney, or SDIRA custodian before making any investment decisions. You need to keep detailed records of all transactions involved in your self-directed IRA. That's why a lot of these custodians are there for you to document the paperwork, make sure everything's accurate. They're not going to tell you if an investment is good or bad. You still have to do your own due diligence. They're there to basically document up the file, okay? Now, people ask me too, what about the backdoor Roth IRA? Now, that's not some weird, crazy sex position, a backdoor, okay? A backdoor Roth IRA is kind of a newer thing that's pretty cool out there. A backdoor Roth IRA is a strategy that allows high-income individuals who are ineligible to contribute directly to the Roth IRA to still get money into a Roth IRA through a workaround, okay? It involves contributing to a traditional IRA, which has no income limits for contributions, okay? And then converting that traditional IRA to a Roth IRA. Now, what is necessary, okay? Roth IRAs offer significant tax advantages. We know that qualified withdrawals in retirement are tax-free. However, the IRS sets income limits that restrict who can directly contribute to Roth IRA. For 2025, those limits will likely be similar to 2024, and they are. Where if your modified adjusted gross income is above a certain level, you cannot contribute at all. The backdoor Roth IRA is a way for high-income earners to bypass these limitations. You're just going to pay the taxes on that money at first. So if you're going to say 10 grand and roll that to a Roth IRA, you're going to pay the taxes on that 10 grand to convert it. Okay. Now, how does it work? It's a typical step-by-step process. It's pretty simple. First of all, contribute to a traditional IRA. You contribution to a traditional IRA. Importantly, this contribution may or may not be tax deductible, depending on your income and whether you're covered by a retirement plan at work. Even if you are not eligible to deduct a traditional IRA contribution, you can still proceed with a conversion. That's something to keep in mind. Okay. So like I said, for 2025, that's $7,000 to contribute plus a catch-up clause of $1,000 if you're over 50. You then convert the traditional IRA to a Roth IRA. This involves transferring the funds from the traditional IRA to a Roth IRA. I've heard custodians say they just rename it and reclassify it and then pay the tax. Okay. The conversion itself is generally a taxable event. You will owe income tax on any pre-tax amounts if the traditional IRA that is being covered. There's something called the pro rata rule. This is a critical consideration. The IRS applies the pro rata rule, which means that all of your traditional IRA assets, including those in other traditional IRAs, SEPs, and simple, are considered when calculating the taxable portion of the conversion. The taxable amount is based on the proportion of after-tax contributions to the total value of all your traditional IRAs. So let's give you an example of this. So let's say you contribute $7,000 to a traditional IRA, non-deductible. Okay. You also have $93,000 in other traditional IRAs from rollovers over the years, all of which is pre-tax. Your total traditional IRA balance is $100,000. Only 7% of that total is after tax. Okay. Therefore, only 7% of the converted amount would be tax-free. The other 93 would be taxed as ordinary income. Okay. Now, there are ways to avoiding the pro rata rule. The pro rata rule is why it's generally not a good idea to do a backdoor Roth IRA if you have a significant pre-tax balances in other traditional IRAs. In this situation, you would need to pay taxes on the vast majority of the conversion. Some strategies to avoid the pro-tax rule include rolling pre-tax IRA funds into a 401k. If your employer's 401k plans allows it, you might be able to roll your pre-tax IRA balances into the 401k, effectively emptying your traditional IRAs before doing the backdoor Roth. This allows you to convert the only non-deductible contribution and minimize the tax hit. So that's something to think about. Roll into your employer's 401k, roll it back out. Who is the backdoor Roth IRA for? High income earners, those who exceed the income limits for direct Roth contributions. Those without large pre-tax IRA balances. The strategy works best if you don't have significant pre-tax money in traditional IRAs due to the pro rata rule. You know, if you think you're going to be making a lot more money, you might want to make sense before you get that more money to start the Roth IRA or to the traditional, do a conversion to it, and then go from there. Okay. Record keeping. Obviously, you need to keep accurate records of non-deductible contributions to your traditional IRA to prove that you've already paid tax on that money. The IRS form is 8606 to report non-deductible contributions and Roth conversions. Your self-directed IRA custodian should be able to help you out with that. And then, of course, we all know that legislation can change. Like Biden was trying to change some of these IRA terms. Who knows what's going to happen? I don't see that happening as long as we have a Republican in the presidency. Okay. There's also something called a step transaction doctrine. The IRS could argue that the contribution to the traditional IRA and the conversion to the Roth IRA are a single integrated transaction designed to avoid the income limits. While the IRS hasn't formally challenged the strategy, it's a theoretical risk. Okay. This risk is reduced if there's a significant time lag between the contributions and the conversions, although this isn't a guarantee. In summary, a backdoor Roth IRA can be a valuable tool for high income earners to get money into a tax advantage Roth IRA, but it's crucial to understand the rules, especially the pro rata rule, and to keep accurate records. As always, consult your tax experts. Okay. Now, there's also something called a checkbook IRA. All right. A checkbook IRA, also sometimes called an LLC IRA, is a type of self-directed IRA account that gives you, the IRA owner, greater control over the IRA's investments and funds. It achieves this by structuring the IRA to own a limited liability company, an LLC, and then the LLC is what makes the actual investments. Think of it as giving your IRA its own checking account to use for investments. Now, I've seen these range from anywhere from $1,000 up to a couple $1,000s to set this up, because you're setting up not only the IRA, but also the LLC. So this will vary a little bit state by state in some cases, okay? So how this works, you establish a self-directed IRA. You open a self-directed IRA with a custodian that allows for this type of structure. Not all custodians do, okay? You form an LLC. The SDIRA then forms a limited liability company. The sole member of the LLC is the IRA itself. The LLC's operating agreement is carefully drafted to ensure compliance with IRS rules for IRAs, okay? Then you fund the LLC. The SDIRA transfers funds into the LLC's bank account. So that's something you got to keep in mind. Money's got to flow from the SDIRA into the LLC. As the manager of the LLC or through a designated manager, you now have the authority to make investment decisions and write checks directly from the LLC's bank accounts to make those investments. The investments are held in the name of the LLC, which is owned by the IRA. So you'd have to put money into the IRA and it flows into the bank account. That's something to keep in mind. It's the same thing with self-dealing. You can't use this checking account for the same self-dealing rules. You can't, where it's going to benefit you personally. It has to benefit the LLC and the IRA, okay? Benefits, you have greater control. You have much more direct control over investment decisions. You don't need to get approval from the SDIRA custodian for every transaction, which can save time and reduce fees. Faster transactions is one of the biggest things. You can act quickly on investment opportunities because you have immediate access to the funds via the LLC checkbook or debit card or wire transfer. Especially useful for real estate investments where speed can be crucial. This is one of the biggest things I say is advantage for note investors, because there's not a traditional closing, and a lot of these regular IRA custodians, they will screw shit up when it comes to closing. I've seen like equity trusts like delay things by a month or more because they didn't understand how the transaction was working. So an IRA LLC can be very beneficial if you're using it on a regular basis. Reduce fees. While there are upfront costs for setting up the LLC, ongoing transaction fees charged by the SDIRA custodian can be reduced because you're not actually holding it in their accounts, as they're no longer involved in every investment decision. And there's expanded investment options. Like any SDIRA, it allows for investments beyond traditional stocks and bonds, such as real estate, private equity, precious metals, etc. Okay. Privacy, your IRA investments are held in the name of LLC, offering a degree of privacy. So that's nice that people can't go and do like a search for equity trust or Quest Trust or Advana or IRA services at the county records to find people who have an IRA. It's literally going to be in the name of the LLC. Okay. Now, there are some drawbacks and risks. Complexity setting up and managing a checkbook IRA is more complex than a traditional IRA. You need to understand the LLC formation, operating agreements, and the IRS rules. There are usually a little higher upfront costs with forming an LLC, legal fees, and state filing fees, and that's going to vary state by state most of the time. And yes, if you're in California, you're going to pay an $800 fee per year on that LLC and your IRA, just because it's California taking a pound of flesh. If you violate the IRS rules, your entire IRA could be disqualified, resulting in significant tax liabilities. You got to understand the transactions, and they've got to comply with the IRS. That's what I've got to say. You really can lead to serious penalties if you screw shit up. Custodian oversight. While you have more control, the SDIRA custodian still has a responsibility to ensure compliance. They may require periodic reporting, may conduct audits. That's the other thing. If you have any type of self-directed account, they're going to want a value of the IRA sent to them year in, year out. Okay. So by April 15th, they're usually going to want some sort of valuation of the property, the note, whatever you host or whatever you hold as far as assets in that IRA. And they're going to tax you or charge you a fee based on that percentage. So if you've bought stuff that's grown in value, make sure it's only the value of what you own, not the full amount. Okay. Like I had one guy who put $50K into a multifamily, put the value of the IRA as the full value, and you got this big penalty, a big fee, and because he was based on the value of the apartment complex. Well, he only owed like 1/8 of the apartment. So he had to go back and adjust it down to 1/8 value and go from there. I tell people, like, listen, until you realize that profit or you're getting, like notes, getting money back in, put just the value based on what you paid for it, especially in a non-performing note. Put just the value of what you paid for the note until it gets performing, and then you can reclassify it, okay? There are some scams and misleading information. Be wary of promoters who overstate the benefits of checkbook IRAs or downplay the risk. Always do your own due diligence. Very, very important. They're not for everybody, all right? If you're not going to be an active full-time investor, I would say just go with a regular IRA, self-directed IRA, until they screw that up, and then it may be faster for you. But if you're just doing a part-time investment, like performing notes, stuff like that, most of the people that I know, if you tell them that you're using a self-directed IRA to fund the deal, they'll give you a little bit more time to get things closed. Okay. Once again, prohibited transactions. Rules apply for checkbook IRAs just as they do for self-directed IRAs. You cannot engage in transactions that benefit you or other disqualified persons. This is the biggest area of concern, okay? Arm's length transactions, all transactions must be conducted at arm's length, meaning they must be fair market value, not designed to benefit you personally. And proper documentation. You must keep meticulous records of all transactions made by the LLC, expenses paid, stuff like that. Now, this does make a little bit more sense if you are buying an active asset, you've got to pay vendors, servicing company, people to go mow your rental properties. It might make sense to do that where the IRA LLC is paying them and makes it easier for you, okay? It's suitable for experienced investors, those who have a good understanding of investments and are comfortable managing their own affairs, those people that are seeking greater control, who want more direct control over their IRA investments and can do things faster. Frequent transactions. People anticipate making frequent investments, especially in assets like real estate, is important. Now, one thing you could do is use your IRA to fund the transaction and then get refinanced out of the deal to get your IRA money back at a percentage. There's something to think about that. And then those are willing to take on responsibility a little bit more, okay? A checkbook IRA can offer greater control and flexibility for investors, especially self-directed IRA investors, but it also comes with increased complexity and responsibilities. It's essential to understand the rules and potential risks before setting up one. Consult with your legal and tax professional to determine if it's the right choice for you. All right, everybody? So that's my kind of basic. You have anywhere from an ESA, educational savings account of $2,000 all the way up to $69,000 on a solo 401k or a SEP IRA. So lots of opportunities there for you. Start something. Just start doing something and put money into an IRA. Go set one up, put $1,000 in it, $500 into it. You know, one thing to ask your custodians is, what's the minimum investment amount? We've wholesaled notes into our IRA before for as little as $200 was the wholesale fee, or the fee that we had to put under the contract that the IRA could fund. The thing about that is a bank is not usually going to allow you to put an option on a note for $200 and flip it. So those are going to be more applicable in like buying private notes, notes from other investors. Partials are great for self-directed IRAs, not so great for if you're buying direct from a bank and stuff like that. So keep that in mind, and hope that was helpful. And go out and take some action, everybody. We'll see you at the top. Get set up today. If you don't have a self-directed IRA, feel free to reach out to me directly at scott@weclosenotes.com, and we'll gladly direct you to the IRA vendor of our choice. So go out, and we'll see you at the top, everybody. Bye. Hey, real estate investors. So you want to dive into the world of note investing, but don't currently have the funds to sign up for an expensive class or a workshop or one-on-one coaching. Well, then you definitely want to check out the biggest bang for your buck in the note world, and that's our WCN membership. It get you an all-you-can-learn access to our class workshop replays, tapes, weekly coaching calls. For $97 a month, it's the biggest bang in the note industry because you get access weekly with me. You can book one-on-one phone calls with me. As we get different tapes in, we'll share them with our members after our one-on-one coaching students get access to us. We share a variety of tools, like I said, replays to the previous workshop, special discount codes to other events that you can take advantage of to help you get more bang out of your dollar every month. We've been investing in notes for over 20 years, and one of my biggest passions is helping note investors, big and small, get started buying notes. Yes, I got started years ago with no money, no savings, and no list, and I love helping people close on their first deal, get their first private funding partner to help them fund more deals and help them both make above average returns. If you're looking for somebody to help you take your note investing from 0 to 60 and want to get started, my WCN membership is a great place to get started. Like I said, we upload lists to it, video training, coaching calls for $97 a month. What can go wrong? The only thing we ask is you hang around for 6 months, and then if you don't like it, you can cancel. But check it out at noteumbrella.com. That's noteumbrella.com. That's our WCN membership. Get looking at assets today. Start putting your fingers on the trigger to pull the trigger on some note deals here before too long. Yes, anybody can buy notes. I don't care your age, your savings, what race, color, whatever it is. Note investing is all about what action you take, and the first action you should take is signing up for our monthly membership at $97 a month. That's noteumbrella.com. You can also access it by going to weekclosenotes.com and checking on the monthly membership. But we are here to help you. Scott Carson, the Note Guy. We look forward to seeing you at the top.